Welcome back to The Explainer. Today, we're tackling something that usually makes people sweat: stock market crashes. But hey, instead of hiding from the scary headlines, we're going to look at what the hard data actually tells us about why markets collapse, the historical patterns that always repeat, and how you can actually survive and even thrive when the inevitable happens. Here is our roadmap for today. We'll quickly cover the anatomy of a crash, history's biggest financial bubbles, the looming threats and debt we are facing right now, and finally, how to survive the next reckoning.
Okay, let's just dive right in. I want you to think about this one simple question. What happens when fear overtakes confidence? At its absolute core, that right there is the human emotion driving every single financial panic in history. I mean, a market is really just a collection of people, right? And when those people get more terrified of losing than they are confident in gaining, well, the whole foundation starts to crack.
Which brings us to part 1, Anatomy of a Crash, Mechanics of the Panic.
To really get this, we need to cut through the jargon. What actually is a bubble and what is a crash? Think of a bubble like a giant balloon getting blown up by irrational hype and excitement. Everyone's convinced prices will literally just go up forever. But, eventually reality sets in. The hype evaporates, demand vanishes overnight, and bam, the bubble pops, giving us a rapid, crushing collapse.
And when that pop happens, the psychology completely flips. You get this massive surge of panic sellers who are willing to dump assets at pretty much any price just to stop the bleeding. But at the exact same time, all those confident buyers, they completely vanish. They just sit on the sidelines waiting for the bottom. So you're left with overwhelming supply, absolutely zero demand, and prices just go into a total free fall.
Let's move on to part 2, history's biggest financial bubbles, a cyclical phenomenon. Because it turns out, human greed and panic, not exactly new.
History shows us this underlying psychology never actually changes, only the assets do. Think back to 1637. People leveraged everything they owned to buy rare Dutch tulip bulbs. Yes, actual flowers. Until nobody showed up to an auction and the whole thing crashed. In 1929, Americans bought stocks on massive margin, setting off the Great Depression. Fast forward to the year 2000, and investors were throwing millions at literal worthless companies just because they had a .com in their name. And 2008? Well, that was housing. Honestly, the 2008 crash was fueled by sheer absurdity. Wall Street was handing out ninja loans. That stands for no income, no job, no assets. If you had a pulse, you got a mortgage. They bundled all these toxic, high-risk loans together and sold them off globally as safe investments. It was basically a giant Jenga tower of lies. And when borrowers inevitably couldn't pay, the entire global banking system nearly went under. But modern crashes, they've got a terrifying new twist. Early panics were driven completely by humans, but events like the 1987 Black Monday and the 2010 flash crash were dangerously accelerated by computers. High-frequency trading algorithms and automated portfolio insurance triggered millions of sell orders all at once. Trillions of dollars just vanished from the market in a matter of minutes. Unbelievable.
Let's pivot to part 3, looming threats and debt, today's red flags. We need to look objectively at the hard data hanging over our economy right now.
Consider this staggering number: $38 trillion. That is the current U.S. national debt. To put that massive figure into perspective, the government is now expected to spend more money just making the interest payments on this debt than it actually spends on national defense.
There's a quote from the data that hits the nail perfectly on the head here. Our fiscal situation is a 350-pound, 2-pack-a-day smoker on the ICU table. It's a harsh metaphor, but if this kind of unsustainable borrowing continues, it could eventually trigger a total collapse in the bond markets, simply because investors lose faith that they'll ever be paid back.
Then there's the Buffett indicator. This basically divides the total valuation of the stock market by the nation's GDP, comparing stock prices to actual economic output. Right now, it's sitting around 241%. That means the stock market is significantly more overvalued today than it was right before the dot-com bubble burst.
Plus, there is massive concentration risk hiding in plain sight. Just 4 massive tech and AI companies are driving an estimated 75% of the gains in the S&P 500. Just 4. That means the vast majority of the market's apparent growth is being propped up by a handful of businesses. If they stumble, the whole index goes down with them.
Add to that a landscape of constant economic shocks. In 2020, we had the fastest crash and recovery ever, heavily fueled by stimulus. In 2025, sweeping trade policies brought in massive import taxes, which triggered retaliatory 34% tariffs internationally and caused a sudden 4,000-point drop in the Dow. Meanwhile, high inflation is squeezing the bottom 90% of consumers, spiking credit card debt and defaults. Markets absolutely hate uncertainty, and all these factors inject massive instability into the system.
So what do we do about it? That brings us to our final section, surviving the next reckoning, the investor's playbook. Let's move from macro doom to micro control. Every market crash follows three cyclical phases. First, the euphoria phase. Irrational excitement, high debt, everyone's buying in. Next is the reckoning phase, where reality hits and panic selling destroys valuations. But here is the absolutely crucial part. There is always step 3, the phoenix phase. The market recovers, rebuilds, and historically pushes way past its previous highs. A bull market almost always follows a bear market.
The key is knowing where the money actually goes during a panic. Highly stable assets, like short-term treasury bills, act as a safe haven for your cash. On the flip side, high leverage margin trading is extreme risk. It forces you to sell when you get a margin call, completely wiping you out. And diversified index funds? Yeah, they'll see a temporary drop, but the historically proven strategy is to hold your nerve and accumulate more while they're cheap. So here is your historically backed survival playbook. First, build a 3 to 9 month emergency cash fund before the storm hits, so you're never forced to sell stocks just to pay rent. Eliminate your margin debt. Diversify across different sectors and company sizes, and use dollar cost averaging to buy the dip consistently. Whatever you do, do not panic sell trying to guess the bottom.
Warren Buffett said it best: be fearful when others are greedy and greedy when others are fearful. True generational wealth isn't built when the market is booming. It's built during that reckoning phase by prepared investors who keep a cool head and buy excellent assets at a massive discount while everyone else is panicking.
Ultimately, preparation beats panic. You can't predict the next pandemic, the next tariff war, or when the next bubble's going to pop. But you can entirely control your own portfolio's resilience. Manage your risk, know exactly what you own, and let compound interest do the heavy lifting over the long haul.
I want to leave you with this final thought. It is not a matter of if, but when. When the next inevitable crash wipes trillions away and the headlines are screaming about the end of the economy, will you be among the panic sellers acting out of fear, or the prepared buyers stepping in with confidence? Start preparing today. Thanks for joining me on this explainer, and I'll catch you in the next one.